Welcome to this explainer. Look, if you've ever tried to power through a financial prospectus, you know exactly what I'm talking about. They are incredibly dense, packed with so much legalese, it's enough to make your eyes glaze over. But hey, that's why we're here today. We are doing the heavy lifting for you. We're going to completely peel back the layers and translate the dense legal risks of one specific fund, the Alpha Architects U.S. Equity 2 ETF, or AAEQ. We're making this totally accessible so you know exactly what's going on under the hood.
So what are the actual real risks of AAEQ? Because when you open up that prospectus, you're immediately hit with a list of 19 plus different risks. It's dry, it's overwhelming, and frankly, it's pretty hard to make sense of in the real world. To really grasp what's at stake here, we're going to categorize this giant laundry list into a narrative framework that actually makes sense. Instead of just rattling off warnings, think of this investment like a road trip. We're going to map out the specific hazards you might actually hit along the way. All right, here is our roadmap for today's explainer. We're looking at broad market and equity risks, structural and ETF risks, active management strategy risks, and finally, taxes and turnover risks. Let's get into it.
Section 1, Broad Market and Equity Risks. The macro weather affecting everyone on the road.
You know, before we dive into the highly specific, really unique strategies of AAQ, we absolutely have to acknowledge the baseline risk. Since AAQ seeks broad-based exposure to the U.S. equity market, it is fully out there, exposed to the elements. If there's an economic recession, geopolitical unrest, or if interest rates start bouncing all over the place, the broader stock market is going to fluctuate. In a general downturn, well, multiple asset classes fall and this fund's equity holdings will take a hit. It's basically the unavoidable weather of investing.
And depending on what that market weather looks like, different types of companies face very unique impacts. AEQ can hold large, mid, and small cap U.S. companies, and every single one carries its own baggage. Large caps, they can be matured and a bit slow to adapt, so they might trail the broader market for years. Mid caps are way more sensitive to market shifts because their industries are still evolving. And small caps, man, they are subject to wild, unpredictable price swings and lower trading volumes. That makes them a whole lot harder to offload when conditions get tough. If AEQ is holding them when a storm hits, those vulnerabilities literally become your vulnerabilities.
Okay, Section 2, Structural and ETF Risks. The specific risks of driving an ETF vehicle.
Let's talk about the concept of an authorized participant, or AP. See, ETFs don't just magically create and destroy their own shares. They rely on a very limited number of financial institutions, these APs, to process all that creation and redemption. And AEQ actually carries a specific concentration risk here. If these specific players decide to exit the business, or if market makers just step away during stressed conditions, AEQ shares could face severe liquidity issues. They could trade at a massive discount, or worst-case scenario, face delisting from the exchange entirely. No way around it. That's a big deal.
So the really crucial point here is how this mechanical structure directly hits your wallet. We call this premium discount risk. Because ETF shares trade on an exchange, the market forces of supply and demand are what actually dictate their price. When market volatility spikes, the trading price of AEQ shares might deviate significantly from the actual net asset value, the NAV, of the underlying stocks. This means you run the very real risk of paying a premium, like paying more than the underlying stocks are actually worth when you buy, or selling at a steep discount when you're trying to get out.
And there are a handful of other structural speed bumps we should rapid fire through. First, the cost of trading means you'll be paying bid/ask spreads that can really widen out during volatile periods. Then, trading halts. Market chaos can trigger exchange circuit breakers and just freeze your assets. You've also got liquidity mirroring. If the underlying small cap stocks dry up and become illiquid, the ETF itself becomes illiquid. We can't forget new fund risk either. AAEQ is recently organized, so there's no long-term track record to evaluate. And lastly, counterparty risk. If the fund uses options, there's that slight but severe possibility that the options clearing corporation fails to meet its settlement obligations. All these structural factors, they can just steadily chip away at your returns.
Moving on to Section 3, Active Management Strategy Risks. The route and the drivers.
A lot of investors hear ETF and instantly assume it's just passive index tracking. But AEQ is actively managed, which introduces management risk, basically the risk of human error or poor judgment. The success of the fund depends entirely on the sub-advisor's skill. But here's the real kicker, and it's stated right in their prospectus. The sub-advisor doesn't perform any type of fundamental or quantitative analysis on the component companies. None. Instead, security selection and weighting are driven almost entirely by market capitalization. So you're relying on a highly specific mechanical process rather than, someone actually doing deep dives into a company's balance sheet.
But wait, there is a secondary active strategy happening here, and it's arguably the defining feature of AAEQ. It's systematic dividend timing. Let's walk through exactly how this works step by step. First, the sub-advisor monitors the portfolio to spot stocks that are about to pay an immediate dividend. Second, they evaluate whether replacing that stock right before its record date makes sense to minimize taxable income. Third, they sell it to exploit pricing imbalances, or demand artificially inflates a stock's price right before a dividend and then drops it immediately after. Now, this brings up a massive inherent investment strategy risk. The AAEQ prospectus explicitly says, and I quote, "There is no guarantee that the dividend timing strategy will be successful in its attempt to minimize the fund's taxable income or improve the fund's performance." End quote. This active maneuver is complex. They're trying to dodge taxable dividends while still keeping broad market exposure. If this fails, or if it just racks up way too many transaction costs, this specific strategy could end up actively hurting your overall returns. Another huge active management factor is annual reevaluation risk. Get this, the sub-advisor only reconstitutes the fund's investment universe once a year, like every April, for example. In today's incredibly fast-moving markets, waiting a full 12 months to reevaluate the universe is practically an eternity. This built-in lag means the fund could completely miss out on major price movements after that reevaluation, exposing you to some pretty severe performance swings compared to the broader, faster-adapting equity markets.
All right, Section 4, taxes and turnover risks, weighing the ultimate cost to your wallet.
Greater than 100%. Because of that super active dividend timing strategy we just talked about, constantly swapping out stocks right before they paid dividends, the anticipated portfolio turnover rate for AAEQ under normal conditions is expected to be over 100%. Think about that. That is a jarringly high amount of churn for a portfolio. So why does that matter? Well, this 100% turnover rate takes a serious toll on your bottom line. We call this the high turnover toll. Rapid training drastically increases brokerage commission costs, which eats directly into the fund's performance. But even worse, this rapid turnover exposes you, the shareholder, to a higher realization of short-term capital gains. And as you probably know, come tax season, short-term capital gains are taxed as ordinary income. That means you could end up paying significantly higher taxes just for holding onto this fund. Finally, there is a highly technical but super important structural tax risk buried in the prospectus: in-kind contribution risk. When the fund launches, it acquires assets through contributions that are intended to be tax-deferred under Section 351 of the tax code. But if there's a hiccup and this fails to qualify, the fund loses its tax holding period. What does that mean in plain English? It means a structural error at launch could completely scramble how capital gains are calculated, which could inadvertently trigger massive, unexpected tax liabilities for the corporation or for you, the shareholder, down the road. Wow. Okay. We have covered a tremendous amount of ground today. We've peeled back all that dense legal jargon to really reveal the true mechanics of this fund. We looked at the macro vulnerabilities, the structural hurdles of ETFs, that highly unique non-fundamental active strategy, and the very real tax and turnover consequences. So I want to leave you with one final provocative question to chew on. Do the potential rewards of AAEQ's active dividend timing strategy truly outweigh the layered structural and tax risks it brings to your portfolio? It is absolutely a critical balance you need to weigh before you decide to invest. Thanks so much for joining me on this explainer, and keep learning.